Imagine this. It's 2026. Markets are moving fast. Headlines are louder than ever. AI stocks are surging one week and correcting the next. Crypto volatility is back, and financial media is split between euphoria and fear. But here's the real question. Are you reacting to noise, or are you investing with a structured understanding of how the economy actually works? According to recent data from the International Monetary Fund, global debt levels remain near historic highs following years of aggressive borrowing by governments and corporations. When debt levels are elevated, economies become more sensitive to interest rate changes. That alone makes 2026 structurally different from the easy money era of the 2010s. At the same time, central banks, especially the U.S. Federal Reserve, have shifted policy aggressively in recent years to combat inflation. Interest rates today directly influence liquidity, stock valuations, real estate affordability, and corporate borrowing costs. And inflation itself is not just a headline number. Data from the U.S. Bureau of Labor Statistics shows how persistent price pressures reduce real purchasing power. If your portfolio grows at 5% while inflation runs at 4%, your real return is barely positive. This is why blindly buying stocks without macro awareness is risky in 2026. Then there's artificial intelligence. A global report by McKinsey & Company estimates that AI could contribute trillions of dollars to global GDP over the next decade. That's transformational. But history shows that technological revolutions create both winners and losers. Not every company survives disruption. Add geopolitical risk, supply chain realignments, and energy market shifts, themes regularly discussed in global outlook reports from the World Bank, and you begin to see the full picture. 2026 is not about hype, it's about positioning. It's about understanding that markets move in cycles, driven by liquidity, debt, productivity, and policy decisions. The investors who thrive are not the loudest, they are the most prepared. And preparation begins with structure. So how do you actually build that structure? The first principle is diversification, and not just in theory. Research published by Morningstar consistently shows that diversified portfolios reduce volatility without necessarily sacrificing long-term returns. Concentration may create big wins, but it also magnifies risk. Equities remain powerful wealth builders. Broad market index funds historically outperform the majority of actively managed funds over long periods. But in a high-rate environment, valuations matter more than ever. Fixed income deserves renewed attention. When interest rates rise, bond yields become more attractive. High-quality government bonds can provide stability during equity downturns. Policy analysis from the Bank for International Settlements frequently highlights how monetary tightening cycles impact asset correlations. Real estate remains another key pillar. Market data from the National Association of Realtors demonstrates how property markets respond differently to interest rate shifts compared to equities. Rental income can provide cash flow even during stock market volatility. Gold also plays a historical role as a hedge. According to research from the World Gold Council, gold has often preserved purchasing power during inflationary periods and currency instability. Now let's address alternative assets. Cryptocurrency markets remain volatile, and platforms like CoinMarketCap track dramatic price fluctuations daily. Smart investors treat digital assets as a small allocation, not a core holding, balancing risk with potential asymmetric upside. Meanwhile, global reports from the World Economic Forum highlight long-term structural trends such as digital transformation, clean energy transition, and automation, sectors that may attract sustained capital flows over time. But diversification alone isn't enough. Liquidity matters. Cash provides optionality. During downturns, investors with liquidity can deploy capital into discounted assets. Those fully invested cannot. Risk management is not about fear, it's about survival. Avoid excessive leverage. Avoid emotional decision-making. Build a system that balances growth and resilience. Because the goal in 2026 is not just maximizing returns, it's building durable wealth that survives volatility and compounds over decades.
Now let's bring everything together into a practical structure. If you were designing a balanced portfolio for 2026, it wouldn't rely on just one asset class. It would combine growth, stability, and liquidity in a calculated way. Imagine allocating around 30% to stocks and ETFs, focusing on broad global exposure, including technology, AI-driven sectors, and resilient multinational companies. Instead of betting on a single stock, this approach captures overall market growth while reducing company-specific risk. Then perhaps 20% in bonds or treasury securities. In volatile markets, fixed income can act as a stabilizer. When equities experience sharp corrections, high-quality bonds often soften the blow. This reduces overall portfolio swings and helps maintain psychological discipline during downturns. Around 15% could be allocated to real estate, either directly through property or indirectly through REITs. Real estate provides something many assets do not: consistent income potential. Rental yields and property appreciation can work together, especially in environments where tangible assets regain importance. Another 10% might go into gold or precious metals. Gold doesn't produce cash flow, but it has historically acted as a store of value during inflationary periods or currency instability. In uncertain macro environments, even a modest allocation can add balance. Then comes a smaller allocation, perhaps 10%, to digital assets or high-growth alternatives. This portion carries higher volatility, but it also offers asymmetric upside. The key is position sizing. Keeping this allocation controlled ensures that volatility doesn't dominate the entire portfolio. And finally, around 15% in cash or cash equivalents. Many investors underestimate the power of liquidity. Cash gives you flexibility. It allows you to buy when others are forced to sell. It provides psychological comfort during corrections, and in uncertain cycles, optionality becomes a competitive advantage. But allocation alone isn't enough. Execution matters. This is where technology, especially artificial intelligence, begins to reshape investing. AI-driven portfolio tools can analyze massive datasets in seconds. They can identify correlations, rebalance allocations automatically, and detect trends before they become obvious to the broader market. Robo-advisors already use algorithms to maintain strategic asset allocation based on risk tolerance and market conditions. However, AI is not magic. It works best in structured environments and historical pattern recognition. In black swan events, unpredictable crises, even advanced models can struggle. That's why human judgment still matters. The smart investor in 2026 uses AI as a tool, not a replacement for thinking. At the same time, avoid the most common mistakes. Do not chase hype. When an asset skyrockets overnight, the easy gains are often already gone. Emotional buying usually leads to emotional selling. Do not ignore macro signals. If interest rates are rising aggressively, growth valuations may compress. If recession risk increases, defensive positioning may matter more than aggressive expansion. Do not over-leverage. Borrowing to amplify returns can feel powerful in bull markets, but devastating during corrections. And most importantly, do not concentrate everything in one idea. Diversification protects you from being wrong. Because in investing, being partially right consistently is far more powerful than being occasionally perfect. For beginners, the most important principle is simple: start. You don't need perfect timing.
You don't need to predict the next market crash or the next tech boom. What you need is consistency. Start small, build gradually. Focus on long-term compounding rather than short-term excitement. Track your portfolio monthly, not hourly. Short-term price movements are often noise. Long-term trends are what matter. Rebalance periodically. If one asset class grows too large relative to others, trim it back and redistribute. Rebalancing enforces discipline. It forces you to sell high and buy lower, systematically. Learn continuously. Study economic cycles. Observe how markets react to policy changes. Watch how inflation, employment, and interest rates influence asset behavior. But never forget, no strategy eliminates risk entirely. The goal is not perfection. The goal is resilience. Investing in 2026 is not about predicting headlines. It's about preparing for multiple outcomes. If growth accelerates, your equity exposure participates. If volatility rises, your bonds and gold provide stability. If markets correct sharply, your cash gives you opportunity. If innovation explodes, your alternative allocation captures upside. That is what a balanced, forward-looking strategy looks like. It is calm, it is structured, it is intentional. Because wealth is rarely built through dramatic moves. It is built through disciplined repetition. If you found this breakdown helpful, make sure to like the video, subscribe to the channel, and turn on notifications so you never miss future investing insights. And I'd love to know, which part of this 2026 strategy resonates most with you? Growth, protection, or liquidity? The conversation starts below.